Welcome back to an episode of the LSCRE Friday edition podcast. We've got my boy in house here, my guy, Casey Stratton, co founder of Tamarack Capital Real Estate stuff. So, looking forward to going over your strategy today, Casey, learning a bit about yourself and kind of how you got here today. But without further ado, thank you for coming on the show.
Thanks, Craig. Glad to be here. I've been listening to you guys for about the past 6 months, and I've been really impressed that you guys bring in some novel takes that I don't see a lot of other guys talking about. So hopefully we can provide some good info on this one.
Well, we want to have only the highest level of guests, people that we really equally respect and appreciate what they're doing. Ditto right back there to you. Unfortunately, just a little color here. Casey and I have had the pleasure of kind of exchanging, I would say, emails really now. Gosh, for I want to say a year, kind of getting to know one another. And then obviously over this last kind of 2025, we've really been able to connect in person more, kind of break bread, have some fun, and get to know each other. So I always try to have guests that I have some sort of rapport with, and you're definitely one of those people.
Appreciate that. Yeah, it's great seeing you again out at the Lone Star Summit, and was really impressed with that event, and it was fun hanging out.
Yeah, well, let's get right into it. Casey, how did you get where you are today? Maybe tell us about your current location and maybe your background that kind of led you into the Tamarack Group.
Yeah, so we're up in Washington State. We focus primarily on Eastern Washington, but I grew up living pretty close to the Seattle area. And I remember growing up, we'd go over to Seattle, and my mom would tell me about this entrepreneur, Bill Gates and Microsoft, and how they're just blowing things up. This is back in the late '90s. And since that time, I was like, I think I want to be an entrepreneur. Who doesn't want to be a billionaire? Um, and so, yeah, I went through college, did my MBA at University of Washington, thinking I was going to be an entrepreneur and go start some businesses. But then I got my first big boy job offer, making, over six figures. And this is back when that actually meant something substantial. And so I was like, well, maybe I'll kind of climb the corporate ladder for a bit. But in the wake of the uh, Great Recession, I got hit with a round of layoffs, and unemployment was pretty high in Seattle. And so I was feeling kind of a little bit lost in there. And I came across the FIRE movement, the financial independent retired early, and that made a lot of sense to me of like, well, why don't we start creating a asset base that we can then make more career decisions off of, take a bit more risk. And so my wife and I started our aggressive investing journey at that point. And of course, being a finance geek, I started trying to find different ways to invest that could get some really great yields. Came across real estate and started just investing our own personal capital into duplex, and we did some partnerships with some commercial retail type things. And that was really my first taste of cash flow and some great equity appreciation with leverage.
Yeah, so you basically, what I'm hearing is you were more conventional. You kind of sideswiped the entrepreneurial world. Then you got into that kind of by necessity, perhaps, or maybe just investing in the space post GFC, which lucky you must be nice. Although I always tell people, yeah, well, I guarantee people in that time, it's only easy to think that after the fact because now you've got the benefit of, results. But when you're in the middle of it, you never know when the market's going to drop and how things are changing. So maybe can you actually just maybe talk us through and walk us through some of your psychology during those moments, and maybe how that relates today with the shift, because I do think there are a lot of parallels. I don't think we're going to see a nasty, nasty recession like that, where you see stock market drop, basically 50% of capital gets sucked out of the market there, if you will, paper gains, paper losses. But that said, commercial is going through a challenging, lack thereof cycle, a challenging time where there's not a lot of trades, people really
Hmm.
recapitalizing and whatnot. So can you maybe talk us through what you felt like then and maybe some mirroring and matching that's going on today?
That is a great question. I got so I, my wife and I purchased our first house in 2012. So this is a couple years after the crisis. A reappreciation of these assets hadn't started yet, and so the houses were still on the market for a long time. But my boss had a more mature perspective and said, "Hey, now's a great time to buy, especially if you can do a little bit of a fix and flip while you live in it." That was an easy entrance in for it, right? But when my wife and I were moving out of Seattle back to Eastern Washington, I started looking at some duplexes, and I thought, some basic numbers. I had zero experience in underwriting any sort of property, but I kind of researched it. Bigger Pockets was a bit of a resource back then, and but I didn't know anybody who'd ever invested in real estate. And so my challenge was you know, doing something a bit unconventional compared to what you see of those people around you. And my mom was even like, "Do you know what you're doing? Like, you could, you could lose a bunch of money." So I was pretty terrified. Um, and I kind of got over that by saying, I'm going to do everything myself to try and save as much money and make sure that this thing produces cash flow. I think anyone who has gone through that understands that you got to lean into your strengths. I mean, I'm sitting there trying to like do repairs. I'm trying to lease out to new tenants. Uh, they all had my personal cell phone number. So, when something happens at night or they're pissed off, they text me. And that was a big growth stage of starting to bring in professional property managers and different team members to help me focus on what I'm doing more better at. But the market, I kind of assumed that we were out of the Great Recession and we were at a more stable state type of situation. But in hindsight, turned out to be a great time to buy. The numbers were a bit easier back then to make pencil. The 1% rule was pretty dang easy. You can get you can
Wait,
get 8%.
listen, Casey, you're gonna have to. I know this one, but this is just if anyone's younger listening to this information right now, the 1% rule, you'll be like, "Are you kidding me?" People had it so easy investing back in the day, and I'll equate that to my experiences with multi stuff. But the 1% rule it's yeah. Please go into it. This is so funny.
They were even talking about the 2% rule back then, Craig. I mean, you wouldn't believe it. But yeah, I mean, the
I'm gonna
1%
throw
rule
up as
is
someone who works really hard and just wants to be in good market timing, but I digress.
right now have a hard time achieving 1% after CapEx and stabilization. A good deal is coming in at like 1.05. So yes, it was easier there. I mean, I bought multiple duplexes and was getting in excess of 8% cash on cash day one. It was nuts.
So, yeah, so let's get it. So, what is the 1% rule for those who don't know?
Yeah, so if you don't know, it's the ratio between 1 month of rent and the purchase price for that unit. So, for example, if uh, a unit's going to rent out for 1,000 a month, and you buy it for $100,000, that's 1%. So you can imagine a 2% rule. You're getting 2,000 a month for that $100,000 cost basis. You're going to be throwing off cash flow. Now in today's market, I mean, we're generally seeing 0.75 up to 0.85 inbound.
That's unbelievable. And just for perspective, like if you're buying in more core areas, right? So let's take the Bay Area, Seattle, if you get kind of that whole, Redmond area, Kirkland area, think of like kind of the nice areas. If you get to the Bay Area, like where I'm from, if you get to New York, anything like that, right? Your cap rate is so negative, it's not even funny. Even if you get to Arizona now, if you're going to buy in a nice growth area, it's about a 0.5 rule, meaning if you buy a house for 800K, you would be lucky to receive about 4 grand a month in rent. So just for perspective, that those numbers have changed. So when I hear these numbers and these people are younger, be like, wait, you guys had it that easy? That's crazy. So I say that all to say that that doesn't mean today is a bad point in the investment market, but you got to be that much better with your buying and acquisition process to make these things make sense, to make these deals work, for the numbers to work. So I just wanted to clear the air on that front.
Mhm.
So I'm happy that was mentioned there. Let's get into though, kind of you said you had those rules there. You're buying duplexes, so you started buying and then getting back to that story. We'd love to hear it.
Yeah, so was dipping my toes into it. I got into a partnership where we invested in our local downtown. We had some office and retail properties. But at the same time, I kind of re-engaged my entrepreneurial aspirations, and I partnered with a guy I knew back from college who had started multiple businesses from a software development company, a little angel venture firm. He even started a solar-powered distillery called Solar Spirits, and he needed a guy with my skill sets to come in. So we both each threw in $100,000 and started growing these businesses. Um, and during that time, was holding on to these real estate assets, and they were cash flow was increasing. It was a great time. And I'm looking at the struggle over here of trying to grow a business that's based off of staff members' billable revenue, and you're always trying to keep production up. And then meanwhile, the duplexes and commercial properties are just throwing off cash flow. So in 2020, was like, you know what? If I take these capital raising skill sets that we've been raising money to invest in like this little angel fund, but apply that capital raising to real estate, and I'd be the real estate manager. Again, I thought I was being very creative here, not knowing that there's this entire like industry and model called, syndication and GPs. So I started a fund and really just again just kind of stumbled into it been learning a lot over the past 6 years, and that's where we are now.
Yeah, well, and it's kind of funny, and one of my thoughts came back to me, which is just like the 1% rule used to apply for homes or 2%. You're really only going to get that if you're in, frankly, markets that you would never want to own in, and probably deals you want to deal with, tenants you don't want to deal with. Unfortunately, that's the nature of things in the residential market today. But kind of a similar vein, I mean, there is the Rollonomics, Jeremy Roll's kind of rule of thumb. He's someone, and he's really gracious and humble about it. He's like, you're probably going to beat me, and I'm probably not timing the market correctly, but he's like, I will only do a deal if it's in a growth market where you've got 150 basis points of positive leverage. What does that mean? That means that your capitalization rate is 150 basis points, so 1.5% on the interest rate, lower than the financing rates. Plain math. If he were to feel comfortable to investing in a deal, you would need to have a 5% interest rate and a 6.5% going in cap rate to have that positive spread. Now, I can assure you this right now, on a market rate deal, if you're going in growth markets, that does not happen. And that was a bare, minimum you do back in the day, buying deals and investing deals in Dallas, stuff like that. So due to more dollars and more capital and more people kind of just holding onto these properties overall, that has really drove the price down, or sorry, the cap rate down on these properties, and also just made investing that much tighter. You probably have more liquidity than ever before and more buyers than ever before, but at the same time, you're not generating the same amount of cash flow and upside there. So these markets are just more what you would call institutionalized. But going back, Casey, so as you mentioned, you kind of started realizing, oh wait, syndication is a great business I want to be in. At what age were you roughly, and then where were you focusing on these strategies? Were you in Eastern Washington at this point, and specifically, let's talk about the market.
Yeah, so well, this was 2020, so I was probably 33 or 34. Had been investing in real estate already for a good 8 years, and yeah, focused initially on Eastern Washington. So we live in Tri-Cities, which is uh, I had a friend tell me it is the fastest growing MSA that no one's ever heard of. And it's interesting because our area was kind of founded back during World War II during the Manhattan Project, and we were refining the plutonium for one of the nuclear bombs. And so what that did was it brought in a lot of intellectual capital, a lot of engineering, a lot of science. And after World War II, a national lab was founded here, Pacific Northwest National Lab, and for a while, we actually had the highest PhDs per capita in the country. Now, what we have is a very diversified 320,000 person MSA, and we have the Columbia River, we have rail, we have interstates, huge amount of intellectual capital, and so we're seeing a lot of well, and a cheap hydro and nuclear energy. So what we're seeing is a lot of major employers moving in, and it has created a crazy boom. I think we're in one of the top 20 fastest growing MSAs right now. And so that has created a very competitive market. We're seeing a lot of California and Seattle money coming in to try and buy up multifamily. So we've been leaning heavy on two strategies here. The first is we are, I think, one of the few boots on the ground people in our MSA that do this full time professionally. And so we have the broker networks to really start getting first glance on deals. And it's funny, I was just listening to an episode you guys released, things you, Rob and Sam, talking about how off market and value add has kind of become a, I don't know, generalized term that really
A
means nothing at
buzzword,
this
yeah.
point.
Yeah.
But
Unfortunately,
it's in,
people have hijacked these terms and phrases. However, it's not for every market, is I think what we're going to get to here, I imagine.
yeah, yeah. But what's funny is I was laughing while I'm listening because we actually did get a true off market deal that one of our broker friends cold called. It's this 86-year-old gentleman who's owned this for years. His cost basis is so low, he's not been trying to push rents. And so we're coming in and picking this up, and we'll be exceeding the 1% rule on pro forma and getting positive leverage very quickly. But it's taken us, I mean, we haven't closed on a deal since last December. We've stood at bat. Uh, it's tough to find deals to swing at. So we're pretty excited about that one. But you can't rely on, I don't know if I'd call it luck or circumstance to present these deals to you. So while we're glad to have this one, we're looking at a second strategy where we're doing developing into a Class A stabilized asset. And so I'm pretty excited about this because we have a prime piece of land that we're going to be developing 140 units on, uh, and we should be closing on that land next week. And we're going to be partnering with one of our developers who has done multiple properties, but because it is such a opportune time, he's kind of normally self-funded these deals, but he's a little bit illiquid at the moment. So we're coming in as the capital partners uh, with him on that. So this will be our first time entering into this model, but we got a lot of experience around the table with all the different aspects needed for it.
I love it. And tell me the size of the property from this kind of older gentleman that you're acquiring it from.
Yeah, this is the smaller one. It's about a $5 million property, 33 units.
Exactly. So that's kind of what I want to get at because we just had Axel Ragnarsson on the show, who's obviously a stud, and he's got a direct to market kind of conversation or direct to market management style or acquisition style, I should say. And sub 100 units, just for the record here, to clarify my words, sub 100 units, you can find these deals like that. But once you're getting over 100 units, we're talking about institutionally owned family offices, sophisticated people who are have analysts going through, looking at everything day in and day out. Okay, so just want to make the distinction. Those things are possible in the world that Casey is in, and those markets, people like Axel. And one thing I really like too is not everywhere has got a lot of development. Just like Axel is talking about in his northeast vicinity, not really much supply coming down there. Similarly, what has supply been like in your market there in Eastern Washington?
I want to go back to the size. I think you made a really good point there. I mean, I look at it as almost like an arbitrage play where institutional capital is too small for them to even think about, right? I mean, a lot of institutional partners we talk with, they don't want to write a check that's smaller than 10, 15 million in equity. So you're looking at much larger properties. This is almost too small for us to focus on too, but we really like the opportunity and we want to make sure that we're keeping engagement with our investor base who is hungry to get their money into something.
And I imagine something
With
like
the,
this, because it is, sub 50 units, right? There's a chance that you could re-tenant this, reposition this property pretty quickly, get a refinance done, or maybe even bridge it and do, a bridge loan for 2 years, apply whatever you need to do, and then either have a refinancing in the future, modeled out both ways, a refinance, or if the market is better, debt's cheaper, you could probably double your money very quickly, I imagine, in an endeavor like that.
yeah, we think there's a lot of upside. Washington State, it's a blue state and it's getting bluer. They just passed legislation where we can only increase rents 7% a year plus CPI. And so we're looking at sub 10% annual ability to increase it. And so, I mean, for example, in this property, rents are at least 20% below market. So if we max that out, it's going to take us 2 years just to get up on market. And so it kind of changes the playbook a little bit where we're slowed down and got to be a bit more deliberate on our underwriting and our strategy on that.
Yeah, makes sense. So, uh, as you do the development play, so you said you're partnering with a bigger developer. So your kind of positioning there is to be the capital partner and basically bring that in there and kind of co-GP or kind of co do that in tandem together. Is that correct?
Correct. Exactly. Yeah, we'll be pure code GP, not fun to fun.
Excellent. Yeah, that makes sense. So I would love to hear, you mentioned that 2025, you guys, this will be the first couple of deals that you're working on specifically in your market. But since you've been in the market for some time, obviously, you have seen the pivots, you've seen the changes from the last couple of years. But, would love to hear how your 2024 went and then kind of how your 2025 is going and maybe some of the lessons that you're learning along the way, just as being a manager, of these properties and being obviously in investor relations, you got your fingers in kind of every endeavor within the business. So would love just once more to hear the 2024, the 2025, and some of the lessons that you've learned along the way.
Yeah. So 2024 was a period of, I think, a bit of growth with us. We closed on 3 apartments. None of them were in actually the Tri Cities market. They were more in Pullman and Clarkston, which is where Washington State University is.
Yeah.
Funny enough, we bought one of the apartments I lived in during college, so kind of funny there to go back and see it. Um, and it was still a very tight market with, the interest rate increases created this freeze in the market where the bid ask spread was ridiculous. So they all had to be, anything that transacted had to be very creative and solving a unique problem. So we ended up buying a 102 unit apartment that the guy was out of California. The property management was out of Seattle, and one of the apartments was 40% vacant. They had turned the heat off inside these units, and so when we had a Arctic chill come down, and every unit that was on the outside of the buildings froze,
Good.
and
Yeah.
those pipes froze. Yeah,
Yeah, good.
and
Makes sense. Good,
and
good business.
Yeah, and then when they thawed out, all that water ran down, so we had all these vacant units, and it had been a year, and this guy hadn't remedied this. So we came in, we they didn't disclose this either before we got under contract. And so when we found this out, we got an extra, I believe, 800,000 in seller credits on it. And so my partner Max is up in Pullman, running crews through and getting these things up and running.
I love that.
Um,
Yeah, Max is a good guy. We played golf together at Raise Fest.
yeah, yeah. So yeah, with that, I mean, 2025 was I think more of the same of just trying to hunt for these creative properties. We didn't force anything in so far, but we finally found one that's working out. And
Yes. Would you say, from your perspective, deal flow and kind of transaction activity is starting to make a bit more sense now than it had been before? Or would you say it's more of just both sides adjusting expectations to meet somewhere in the middle and kind of both be a little bit unhappy?
yes, I think negative leverage is kind of the play with the value add strategy. Um, Lenders I've been working with understand this. They're performing out your LTC on that. 2020, like, so if we go back to the start of 2024, we're talking with sellers here, and they're like, I had this one guy, it's just like, yeah, my phone was ringing off the hook back in 2021, 2022. Interest rates are going to drop, and then, people are going to be calling me again. So I'm not going to, sell at a price that makes sense for you guys. I'm going to hold on to it. And it's like, well, I can't argue with that. All right, man. But that was the expectation that rates are going to go back down to where they were. And we saw that, it's kind of like a little whiplash here, a little teaser, and then bonds, we'll see the Fed rate go down, bonds market goes up. So I think that the expectation that we're not going to go back to normal and cap rates are not going to compress how they were has started to bring some sellers back of saying, look, I'm either going to hold on to this thing forever or it's time to just kind of sell it for what the market's saying it's worth. But what it's saying is what the market's saying it's worth is still um, very skinny margins for the buyers, right? So
Yeah, and that
that's
kind of goes back to the disappearing of positive leverage on kind of these higher end multifamily kind of institutional kind of acquisitions that we're seeing on our side in most instances. I mean, the sad thing is that when capital and liquidity is as bad as it is right now, that's also directly correlated to when it's the best time to buy. These are cliches that are cliches for a reason, but they're smartly a reason, and they're a reason because these things come and go quickly. And sentiment when it's like this, well, that's when deals are best, but that's also when people are most snake bit. But to your point, I just don't really see a world in which, particularly with institutional capital, really kind of taking office out of the equation, and now they're going to reallocate those dollars probably to data centers, to AI stuff, maybe to
mhm.
other things of that nature. Sure, but the capital flows is still going to go deeply into housing and probably industrial storage, which is just going to make the market more challenging to transact and work on.
Yeah, I agree. I'm curious to get your take on this, Craig. There's been this whole thing of like the stress is going to come back in the market as these balloon and the debt turns over on distressed properties. But from what I've been seeing, the banks have been extending, taking their pound of flesh on expensive 1 point origination for a 9 month extension. But what are you seeing on this? And do you think that we're going to start to see any distress enter the market?
It's really interesting you say that. So we're specifically in Texas, right? So uniquely in Texas, so many people leverage an exemption with the traveling tax exemptions. So by virtue of that, and everyone basically had to do that to make deals make sense. And if you're kind of on the investor relations side and you weren't doing what you could to accommodate that, well, you were kind of falling behind. You had to do that. Like there was no ifs, ands, or buts and workaround there. But because of that, it's really delayed a lot of deals that would be coming full cycle. You're starting to see some foreclosures. You're starting to see some sales, but transaction volume is super, super down. So, but on a distress side, I mean, we're also looking in Phoenix, Arizona. Well, what's going in Phoenix? Absolutely no transaction volume. It's only the super, super large kind of 80 million plus dollar stuff where you're going to have to raise about
Really?
40 to 50 million, where there's some sort of, transaction flow because there's liquidity there. But to your point, I mean, basically deals that were bought in 21 and 22 in most markets, they are doing everything in their power, operators, to hold on to those deals, to extend them, to recapitalize them, to do whatever they can to fight tooth and nail and scratch and claw to make it happen. It's
Mhm.
only the deals that are so far gone that are going foreclosure that you even want to scratch your head if it's worth even your while to do it. But most stuff's trading today is trading at a little bit of a discounted cap rate, kind of, core plus deals and, 5 to 5.5 in Houston. Dallas, it's like, 4.75 plus or minus around there, which is still, a lot of negative leverage. And you got to believe in rent growth. And, unfortunately, something you have to consider if you're an investor and an operator is too soon is still too wrong, right? And being a year too soon is still, very impactful and detrimental to your acquisition. So you just got to be better than ever in a business that's tighter than ever on margins, as you said. I mean, I think a lot of investors and a lot of people, two things, have been trained that there's all sorts of margin. You can get positive leverage. All this stuff can occur in your deals when you're in a good growth market. That doesn't exist really anymore, unfortunately. And that, there's all this wiggle room, there's all this space. And, unfortunately, for the better or worse, a lot of these properties are, generally speaking, pretty darn optimized because of all the capital that's flowing into these things. So I say that all to say that, I think some deals are going to be held on longer, and due to that, we're just not going to cycle as quickly. But with that said, I do think there's going to be a lot of deals that are going to start to hit the market that are, kind of at their extensions, kind of even right now, but in 2026 and 27, there's going to be a lot more deals. I mean, my crystal ball is telling me that 2027 to 2031, you're going to see a lot more deals hitting the market because they've extended it. Maybe they're breaking even, but I can speak for us at Lone Star Capital, or LSCRE, I should say now, as our kind of go forward and what we're doing internally. Everything that we own today, we're not going to sell anything, with rare exception, unless there's like a how could you not offer that we get unsolicited from a credible group. But that said, we're not going to sell anything in our $750 million portfolio, about 23 deals, until 2029, and that's in 2030, and that's deals that we bought today and last year. So that just kind of speaks to, when people talk about cycles, that's basically, I'm not talking about, economically speaking, that's just deal going from soup to nuts, start to finish, and transacting. That's kind of what we're seeing. And I can assure you that if you are investing now and are buying now, it's a good time to do so because of those things, because you're getting that discounted and dislocated pricing. But I do think deal flow will pick up substantially at that point.
That's my feeling too, Craig. And you said the word cycle, and I think that's a really interesting perspective to put it in right now, not just on the property cycle side, but also on the operator side. It's my goal, my hope that we had a lot of new entrants come in during the 2021, 22 years because they saw, it was hyped up. Everyone thinks they're making millions and millions of dollars here. And I think that this complete plunge in transaction volume is helping clear out some of the less experienced operators, the people who are in it to get rich quick. And I think that's going to create a healthier ecosystem where we're not seeing people force transactions just so they can get their acquisition fee, but we see things kind of come back into a bit more balance.
Yeah, if you didn't have a really legitimate or solid foundation, or if you were not wholeheartedly aligned mentally, spiritually, and physically to do this business of, real estate at this level, you are getting washed out right now, with very rare exception, which is really good for those who can survive and stay. But it's also a bummer is that, well, what also happens there? It's the collateral damage of the investor that invested with you, but also the other person that kind of wiped out that person's appetite for wanting to do it. It's not easy to convince someone to invest when you can give them all the statistical data and facts that have blood on the street. It's the best time to invest and all of that. Well, it's easier to say that and easier to tell everyone this is the time to do it. It's a lot harder to actually do that if you're the person that just had to, shake your hand, give a capital call, or, you're losing money somewhere else and, things are foreclosed. You think real estate's the worst, and you might just pivot your investing strategy because of this. And it's unfortunate that a bad ecosystem can hurt people like yourselves, but it's kind of why you've been like us, frankly, on the offensive, trying to meet new people, trying to meet new investors, doing everything they can to kind of stay top of mind, whether it be doing conversations like this, LinkedIn posting. You have to do everything right now. And those who are doing everything and are working super hard will prevail. It's just going to be harder than ever before to do it, And also, we have kind of philosophically changed how we want to do stuff from a debt and equity structure. For us specifically, we're going to raise about double the amount of capital now to do, a 30 to $60 million deal. So what does that mean? That means we have to work twice as hard, essentially, maybe even three times as hard today in today's market to get the same amount of dollars in this deal. especially when you factor the economic times. But the reason why we're doing that is because we're getting more accretive debt. So we're getting, fixed rate during the entire duration, agency loans that will probably ensure your cash flow better along the way and increase safety. So, if you do experience other economic downturns, we will prevail through that there. Because as I said, no one knows if this is kind of light at the end of the tunnel and then we're in the first inning of, things being really great. If we're completely reset, we don't know, but all we can do is kind of hedge with the structure we're putting in place today.
I like that. I don't want to go on too much of a tangent here, but there's been some analysis about some of the current administration's economic advisors who are part of the Project 2025, and you look at what the administration is doing on tariffs. Maybe you call it meddling with the Fed, and with working on monetary policy, and they're putting together an entire strategy to try and reindustrialize the U.S., but also uh, artificially push interest rates down and control monetary policy so they can have quantitative easing and buy
Restructure
up the
all the debt
bonds.
that's coming due. Yeah.
Exactly. And the objective of that, in part, one of the ramifications is that asset holders, equity holders are going to see a boom. And that's in part from inflation, in part from assets performing well in a lowering interest rate environment. And so we don't speculate on these types of things for our investment thesis, but we have them in the back of our head where, hey, if we plant these seeds and acquire good assets, there are reasons to think that there's going to be strong tailwinds for these assets, like you were saying, back into 2029 and beyond.
Well, and I actually really am happy that you mentioned as well, above and beyond. This isn't political commentary. This is just how it affects us in our day to day. Just want to be clear here. There's no preference or there's no, this is great, there's a bad. This is just objectively what we have to deal with. And I'm sure you've seen some of the new tariffs being put on for kind of other home appliances, home parts, stuff like that, right? Well, what does that mean? That means if you're building a new home today, you think home pricing and values naturally from inflation are going to go up or go down. Well, if it's more expensive to build it, the price is going to go up. What happens to every single existing and value add structure today? Guess what? Inherently, by virtue of inflation, that property is more valuable today than it was, beforehand. Just because what happens, the replacement cost, which is something that no one was talking about before the market shifted, is now at the
Mhm.
forefront of what people are doing. Because if you're building and buying, as 140 units, that's 140 in kitchens you got to do. That's 140 units where you got to get the lumber for it, the plumbing for it, and now do the labor for it. So those things are big headwinds, but I'm sure you're going to time it perfectly because there's no supply coming online, and you're a smart guy and you chose the A plus location. But this is our exact thesis for value add multifamily. And you mentioned that you would only in a rare instance ever do a development, it sounds like, and you found your rare instance where it's market agnostic, it should do well. And that's exactly why you want to work with experts like Casey and people at LSCRE and kind of the general ecosystem here, is because we're thinking about these things, we're hedging these things, we're factoring how these things work. And kind of what's interesting too, as we go through a macroeconomic thing, the divide also in relation to things becoming more expensive, it's twofold. Number one, it's kind of tough because the stock market's at an all-time high. So equity would be there. So people who own stock market are like, well, listen, it's hard to sell these things when I'm getting crushed on my multifamily or my real estate stuff, but the stock market's at all-time highs. Respectfully, I'm not going to trust your advice. I'm not going to listen to all the reasons why I like the stock market. But with that said, you will find some wins here. You will find some ability to move, especially with value add stuff. This is the time to get into it, though, with that said. And, at some point, there probably will be a pullback or correction in the stock market, but we will just have to see on that one. But until then, it's kind of guys like us scratching our head as to when that will be, because we've certainly felt our correction within the stock market, or sorry, within our business, but that
Exactly.
hasn't been so elsewhere. So it's kind of hard to make sense of it.
Couldn't have said it better, Craig. I talk to my investors, and it's like, I mean, the S&P 500's had a great run, and it's like, guys, now's the time to sell high here, take some chips off the table, and we're seeing real estate in a nice little slump right now. Buy low, and I'm not a financial advisor. I don't want to give advice to them on that, but try and more paint the perspective of equities and stock markets up here, real estate's down here. Maybe we reallocate a bit.
Yeah, or it's just, if you look at your strategy, if you are looking around and seeing people that are struggling in one asset class, just don't sell stock here. Perhaps just reallocate your new funds into an alternative, like kind of what you're seeking, what we're seeking is kind of how I say it. And one thing, Casey, that really does grind my gears, unfortunately, and you'll appreciate this, is people who tell you that stock market's the worst thing ever and how any alt is the best thing since sliced bread. two things are true. Okay. The stock market is great, but this stuff is also great as well. And it's not an either or, it's just incrementally you want to dollar cost average and invest in both things, right? Like if you were someone who maybe got some liquidity or, kind of went to a boot camp and got too high on, the syndication Kool-Aid and you went at the wrong time, you might have lost all your money, unfortunately. And you do have that downside with this stuff. Stock market, you're probably not going to lose all your money, assume you don't invest directly in Enron. But if you just buy S&P 500, you're going to be fine, right?
Hmm.
So that's
Yeah.
one thing that it does bother me that it doesn't do as a service, saying stuff that's just factually incorrect, unfortunately. And I also look at our deals, how we do our stuff is when I'm allocating my dollars, I'm like, okay, well, why is this better than something I know will over time historically probably give me an 8% compounding return? Like, how is this deal better? And if it is better, which our deals, generally tend to be, that's when I get excited. But if it doesn't really hit that, personally, I don't really want to do it. And our team understands that kind of opportunity cost analysis there. We're not looking to do deals just to do deals, if that makes sense.
Absolutely. And look, I love the stock market as well. Most of my investors are, well, half my investor group is more working professionals, right? And so they've been saving in their IRA for years and years. And so it's not so much of a, it's more of a diversification play and get access to different asset classes rather than, poo-pooing the S&P 500. And so let's just reallocate some of this. Uh, I personally am way too overexposed to multifamily just because I like to invest in my own deals. Um, but I think I've got 10% of my asset base in the S&P 500. It should probably be more than that, but I'm a real estate guy.
Yeah, well, it's hard to grow your portfolio and convince everyone when you're not doing what you're saying you're going to do. But that's kind of what we like to do. And I want to be diversified, but I also want to have exposure into a lot of our deals. So as we kind of wrap up here, what are some of the takeaways and some of the principles that you've learned over this course and over this kind of last cycle, if you will, that you wish you knew beforehand, or what you'd maybe advise people when kind of the next go around like this occurs, which will happen at some point. We will be out of this and we will have a new one.
View our investment thesis as more of like the tortoise than the hare. And it was a very challenging time for us in 21 and 22 when they're over leveraging, over underwriting and assuming cap rate compression and double digit rent growth, and they're selling things that it's like clearly this is not going to happen, right? We stuck to our guns. I had investors who were investing with me and other guys, and you know i I had to explain this and kind of deal with the crap that comes from being more responsible in the marketplace, more controlled debt, a little bit deleveraged, like you guys are saying, raising more capital for it. It's a really smart idea, and it dilutes returns, but you're going to be there longer term, right? And as we've gone through this market shift, that strategy has really behooved us. We're seeing a lot of people eating crow and really the reputation being tarnished just because they felt like they had to promise something that either they were foolish to think that they could deliver on, or they were lying to themselves, or but it's coming full circle on it. So I think being disciplined is so hard when you see everyone else making money in the good times, but it's so nice to have on the downturns. The market's always going to cycle.
I really love that you said that. And it's just sad because when you have bad actors, those who really get hurt are not only investors, but it's people like us who do things a certain way and stick to our guns and know things. And, the worst thing you could have is, absurd projections and then be disappointed when, exactly as we thought, if you see a 30 IRR, it's closer to a zero. And if you see a 15, it's closer
Yeah.
to a 15. So we will leave you on that
Yep.
note. Casey, where can
Love
people
it.
find you? Reach out. I know you got a tea time you've got to hit. I'm jealous. It's raining cats and dogs in Phoenix. We're trading weather places. But Casey, I'll let you get to your tea time. How can people find you, your team, if they want to learn more about your development acquisition, as well as your current multifamily deal that you're looking at?
Yeah, I'd say the best thing you could do, go to our website, tamarack.rei.com. I don't know if we can put that in the show notes. We have an investor club on there, newsletter, so you can stay up to speed on everything that we're doing. I'm also on LinkedIn. Just search for Casey Stratton. That's Casey. And yeah, just love to connect with like-minded people out there in the real estate industry.
Awesome. Well, Casey, thank you so much for being a friend, being a part of the show, listening to the show. And, obviously it was great seeing you in New York City not too long ago, and obviously Austin as well. I look forward to hopefully seeing you in the not too distant future. And for all the listeners that are on this show, listening to the LSCRE podcast, we appreciate you and we'll see you next week. Peace.